Hello everyone, my name is Vikas Shukla, and in this video I'm going to examine the often repeated word cash is trash in the light of the present over hot stock market. And I have a lot of respect for Ray Dalio, and the way he explains the things is just marvelous. You can just listen for on and on for many of the um, complex things that he explains in a very relatively easier to understand way, and I simply cannot match him. But I wanted to have this statement, cash is trash, examined from my perspective, which I agree with most of what he says, but I wanted to you to have an understanding and take the steps for you and how this cash is trash, blindly following it may or may not affect you. So let's say, what does that mean, cash is trash, and his view? We are sitting at a 2% of inflation, and it's likely going to be close to 2.5%. That's what the current prediction stands. It can be a little lower or a little higher, but let's say if there is a 2.5% inflation, and if you are sitting on a cash of, let's say, $100,000, you're not investing in any bond, you're not investing in any CD because they are giving very low interest. You're just sitting on a cash. Then by 1 year passes and you are losing 2.5%, which will be close to like $2,500 for a $100,000, which is not insignificant. It's significant if you are sitting in for a 1 year. If you're sitting on a cash for 2 years, you lose like $5,000, and just because of this inflation. Now, what options do you have? One option is you could buy the bonds. They will, let's say, current in bond return is 1.7% on a 10-year bond. So that turns about to be return, let's say it's 1.5%. You still lose 1%. It gets slightly better, but you still lose it. And another problem with the bond is that their prices could go lower, and then when you sell the bond, you could lose more than 1%. If you go back a couple of months, the bond prices were higher, and the return was even lower. So the bond investment in the bond was like as bad as the inflation, because you could get like 0.5%, but the bond prices they are falling actually now, and then in total you lose about as much as the inflation. So what's your third option? Your third option is to buy stocks. Now, stocks as an asset as of now is risky, because the whole market is sitting on a bubble, and you lose possibly like 15%, maybe 10%, maybe 20%, 30%, and we don't know. But we don't know when that stock price down could start. So that means what options we are. I wanted to now examine what a very big hedge fund's perspective. Now, if I am a hedge fund manager, and I'm sitting on a, let's say, $100 million of the fund with me, I have to manage these things, and I want more people to give me more money, from $100 million to, let's say, $500 million. How about $1 billion? And I am sitting on that fund. So why would people give me that money if I'm just sitting it on the top of it? And what return I am promising to them? I say, okay, a year later, I am promising you minus 2.5%. Why would they invest in me? Absolutely no, they won't. If I say that I take your money, I return you 2.5% minus, then there is no reason for me to exist. So I need to do something. I need to invest that money somewhere, and that at least has a chance of getting you some return. So what do? I say that I would invest it somewhere. I will diversify it. I will diversify it to, maybe if it's not in US, maybe I invest in China. So to diversify it, maybe I will diversify it into gold. That's what we see, this buzzword, diversification. I diversify it. And what, not even that, because the interest rate is low, Dalio even say that borrow the cash, because this interest rate is so cheap, borrow more cash and do something with it to buy something that will potentially give you more return. So so that's the whole idea of keep taking risks, but at least don't promise a negative minus 2.5 rate of return if you want more people to give you money that you can invest in somewhere. So that's what my understanding of this cash is trash thing in terms of these things. Now let's move on to what you are a small investor like me and you. What we are going to do, you may have, for example, 100K sitting in your 401k, lying in your 401k. What you are going to do with that money at this particular point of time? Now there are two things you could do, and probably I will say there's a third alternative. And here is my suggestion. You could park that money in a stock, you could park it in bonds, and you could park it into cash. My advice would be to actually divide it into 3 different parts. One is cash, another is stock, another is the bonds. Now, at this point of time, my ideal scenario would be to at least take out 50% of that and park into just cash, not even in bond. And by doing that, because I cannot take that whole money out because then it would be taxed, the 401k money, I would actually take that money out of the stock and put that money into cash, which means that I will be losing at the rate of 2.5%, but I will not potentially be losing at the rate of possibly 15%, 20% or 30%. I'm reducing that risk. Now, how do you do that? You need to readjust your portfolio and search for, there should be at least one way where you could be seeing something like Vanguard cash or something. Just search for the cash word when you list up the options. And I know I'm losing 2.5% and I'm okay with that. And the moment this stock market goes down by like 10.5% or 10% or 15% or even more, I reinvest it back. Or the second option could be when the bond market, when the bond values go lower and the bond interest rate is back to at least the level where it's matching the inflation rate, maybe 2%, which I am expecting it to be there in next couple of months. Stock, it's very hard to predict. In either of these conditions happen in like next 6 months or a year, I would start investing into that. So that's these are some of the strategies that I have listed out. You keep some dry powder ready when the market is down. Keep at least some money. If you have like 100K, keep like 30, 40, 50K ready. Move your money from 401k stock to cash and keep that dry powder ready when the market is down. And if it does not, you do lose 2.5%, which is nothing. I mean, it's not. I mean, it could, in the 2 year, you could lose at the max 5%, which you could buy, which you could minimize that 2.5% to say 1% by moving that money at suitable point to bonds. And then when the stock market is down by like 15%, invest it back into the stock. There's another strategy that I use is to use instead of, and that's probably the option if you have your own account, your own IRA account or your own brokerage account. Enable the option selling and then use this put sell option, which means that you you intend to buy a stock when its price will be down by like 15% from this current stock price. So that actually absorbs those 15% risk that is that they are inherent with this current stock market price. So this is what I believe. I mean, you can have your own views, your own thoughts, and you could believe in cash is trash and thereby keep investing, diversifying the Ray Dalio way, or you could follow this method. I mean, I will leave it up to you, but just keep analyzing. Don't just blindly follow either my or anyone's advice. Thanks for taking a look.